Hi, very good afternoon to all of you. If you look at global economy, central banks around the world are raising interest rates, and this is resulting into little bit of containment of inflation. Of course, the drop is not as much as they would have loved, but undoubtedly both inflation as well as growth is getting subdued, getting contained. Will this result into some sort of recession? Well, in countries like Germany, recession has been officially announced, and the probability is increasing in some of the other countries. Fortunately for us, we are relatively in a far better shape with zero probability of recession. If we look at US economy, they had one of the fastest rate increases, but the liquidity provided through Fed balance sheet didn't come down as much. In fact, in between, it went up thanks to the SVB crisis. Now, SVB crisis is behind them. They have started taking away some liquidity, but after adding 5 trillion, if you take out 500 billion, obviously the impact will be subdued. The US banking system post SVB crisis is very, very cautious in lending. Their lending standards are becoming tighter and tighter, and this is creating some tailwinds for the growth. As interest rates in US have started moving up, so has the interest burden on US government. Their interest burden today is at the highest level in history. Is SVB crisis behind us? Answer is probably no. Lot of small banks had exposure to commercial real estate, and many of the commercial real estate in US is remaining vacant. I'm sure many of you would have heard that the largest hotel in San Francisco, the operator just walked out saying that this is no longer viable and let the lenders have the hotel. What is happening in hotels is also happening in office building, and this is going to put pressure on small banks which have large exposure to commercial real estate. When the debt ceiling negotiations were going on, the US credit spread widened. However, hopefully with the debt ceiling negotiation over, this should start normalizing. We have been saying that Fed will raise interest rates higher to contain inflation, but they will not stay higher for longer. And this is essentially coming from their past behavior, where over last 3-4 decades, Fed has not remained higher for longer. The quickest turnaround was in 87, where they just took 1 month to move from raising rates to cutting rates. The longest one was in 97, 98, when Fed took 18 months to turn around. We believe Fed turnaround time will be far lower, somewhere around median or average in terms of pivot from raising rates to cutting rates. Indian economy headlines continue to give positive surprise. Q4 FY23 growth rate came ahead of expectations. If we look at decade of transformation, there has been growth everywhere whether it's mutual fund investments, foreign direct investments, highway constructions, GST collections, electrified railways. Everywhere transformation is visible. We were earlier coach to the global growth train. Now we are becoming engine. Over next 5 years, India will be the second largest contributor, ahead of countries like US, Germany, Japan, UK, France, in terms of global growth. We will be contributing about 13% of incremental global growth over next 5 years. Economic activities are nearly at all-time high level. It shows things are moving in right direction. The PMI for manufacturing as well as services remains reasonably well in expansionary mode and reasonably well ahead of many peer countries. This shows that going forward, the manufacturing and services growth should continue to remain robust. FY23 GDP growth, both for the fourth quarter as well as for the full year, came ahead of expectation, and it gives confidence that finally growth seems to be picking up. GST collection remains above 1,50,000 crore, showing both compliance improvement as well as actual collection improvement. The consumer sentiment, which dipped significantly in COVID, is slowly and steadily moving up, and hopefully it will start touching pre-COVID level in some point of time. The second thing was the rural economy. Even rural economic sentiment has started moving up, and both this gives confidence that consumption should be on the positive side. Corporate leverage remains at 15-year low, as corporates have paid debt from their operations by cutting cost. Capacity utilization is now above our historical averages. Higher capacity utilization and lower leverage is pushing corporates to start investment cycle, and the order flows have started coming back up from the pre-COVID level. One of the reasons for slowdown in economy was real estate, where higher prices, where RERA kind of progressive law impacted real estate sector in the short term adversely. Now, real estate sector has bottomed out from those shocks and have started moving up in terms of both sales as well as new product launches. The infrastructure creation, the infrastructure which was built between 1947 to 2013, almost similar infrastructure is proposed to be built between 2014 to 2024. Whether by building better infrastructure, India will be able to increase its export share. We are one of the few countries whose export market share is lower than its GDP market share. We have become service provider to the world, but we are not manufacturer to the world like China. Could we see a scenario where, thanks to creation of infrastructure, we become competitive and our exports growth pick up, supporting overall GDP growth? The expectation is that not only in goods, but also in services, India should witness higher exports growth in the days to come. For investments, you require money, and Indian banking system is in a very, very good shape. It's almost amazing to hear when Shamrao Vittal Bank had to announce that when you hear SVB in trouble, that's Silicon Valley Bank in US, not Shamrao Vittal Bank in India. Who would have expected that a small cooperative bank in India will have to announce such kind of things against the 16th largest bank in America? Credit growth remains in solid double digits. Capital adequacy remains at all-time high level, and NPAs are at reasonably low level in last 2.5, 3 decades. Put together, banks are equipped to provide financing for investment requirement. Oil prices have started correcting. In our Kundli, Rahu and Ketu both remain oil prices. But fortunately, in last couple of months, oil prices have remained low despite Russia-Ukraine invasion. The only worry or a factor which we have to keep in mind that Saudi Arabia recently announced an unexpected cut in oil output by more than 1 million barrels per day. If you take out supply from oil market, obviously prices can move higher. The other worry for India remains El Nino. As per the IMD predictions, monsoon should have begun in Kerala somewhere around first week of June. Thanks to some cyclonic pressure that has been delayed. In the meantime, Australian Weather Bureau has raised warning level on El Nino. We'll have to see whether this building up of El Nino will have any adverse impact on Indian monsoon or not. A large part of economy remain rain-fed. We require a good monsoon to continue momentum of economic growth. However, over the years, as non-agriculture, non-rural side of economy has grown, impact of El Nino, impact of bad monsoon on inflation, on growth, on rural economy is on the way down. In any case, rural economy has moved away from agriculture to non-agriculture, including handicrafts, trade, and so on and so forth. Infrastructure has also become better, giving mobility to rural India. Hopefully, the impact of bad monsoon will be contained. Coming to equity markets, the FPIs, after selling massively from October 21 to June 22 in India, have become buyers in March, April, as well as May. In fact, in the month of April, India received highest allocation from FPIs in emerging market. If we look at the gap between foreign direct investments on a cumulative basis versus foreign portfolio investment, it is the highest in recent times. Imagine if General Electric or Cummins is investing in India and believes that India is a great country to invest, wouldn't their pension fund be following? Many of the pension funds in these large companies are very, very big. And our feeling is that these pension funds will be following their corporate investments over a period of time. Going forward, we expect this gap between FDI and FPI to narrow down over a period of time, and which will ensure that the FPI number starts becoming positive like April and May 23. One more reason why foreigners will be buyer of India, because India is turning out to be a defensive market. Our volatility vis-a-vis our peer group, our beta vis-a-vis our peer group is coming down significantly. We are becoming the blue chip stocks in emerging market. The FPI's behavior towards India will also be driven by our fundamentals. In Corporate profit to GDP, we are on the way up. In ROE, also we are on the way up. And this combination of fundamentals along with sentiments and everything put together will ensure that foreigners continue to favor India. The fourth quarter FY23 results have also come ahead or in line with expectations. About 21 companies out of 50 companies delivered above expectation results. This was mainly in banking and automobile. 16 companies delivered in line with expectations, and only 13 out of 50 companies delivered numbers which were below expectations. On a valuation basis, we continue to trade somewhere around historical averages, little bit here, little bit there, indicating that markets are fairly priced. Market cap to GDP ratio is little above our historical averages, but significantly below our own highs last year. One other way to look at between October 21 to May 23, well, index is almost similar, but in terms of profit, there is almost 50% increase, resulting into a significant correction in your forward P. Market after almost 2.5 years is where it is, and the profits have grown up by almost 50%, resulting into P ratio coming down, market becoming cheaper. The EPS estimate has more or less remained around 1050 plus for FY 2025. We believe these are the numbers possible based on the FY23 numbers which have recently come out. Mid and small cap, they have now started coming into equilibrium vis-a-vis large cap. Mid caps were little expensive, but now all of them are trading somewhere around their historical equilibrium vis-a-vis large cap. If we look at indices, auto, capital goods, financial services, FMCG, and BankX are at near their all-time high. We have been positive on auto, capital goods, and financial services in our portfolios over some time. Some of the sectors which are still at a discount to their lifetime high are real estate, power, technology, metal, and oil and gas. On real estate, we have been by and large underweight. Power, we did miss the last rally to some extent, but we have been saved by not investing into power companies over a long period of time. IT, we had booked our profits and are now selectively looking to add into our portfolio. Metal and oil and gas remains a slightly underweight sector for us, as it's very, very difficult to predict how commodity prices will move. Domestic investors continue to support mutual funds and flows. And thanks to domestic investors' participation, we have been able to absorb FPI buying. If FPI buying continues to remain positive as we expect, and domestic investors continue to show the maturity which they have demonstrated over the last 2 years, the markets will get supported from a flow point of view. The bottoms of the market will be at a higher level than what many analysts may expect. Does this mean that Indian markets will continue to rise? Well, answer is there is always a tug of war between bulls and bears. Factors which will take Indian markets to the higher level, well, the interest rates are coming down globally, and it will come down in India. That should support equity market, not only from profit growth point of view, but also valuation point of view. As we mentioned over several presentations, India is oasis in the desert. We look whiter and whiter on the street where everyone is wearing black to gray shirt. the support which can come from the market if government loosens the purse to support consumption at the bottom of the pyramid within a reasonable extent. You can't become spendthrift. You can't become you can't extravagantly spend like Western worlds. But today there is a little bit of subduedness at the bottom of pyramid consumption. If government provides some support to that segment of the society, growth will actually pick up. What will be the risk for markets to make a correction from here? Well, the global uncertainty, what happens on Russia, Ukraine, how much more production cut Saudi will do, what will happen to geopolitical situation between China and Taiwan. These are all the factors which could have temporary effect on India. The second thing is global liquidity. Today, Fed has kept balance sheet liquid, so has Bank of Japan, so has European Central Bank. They have raised interest rates but not taken away liquidity. Market believes that they will cut interest rates towards the end of this year. If liquidity gets more scarce and interest rates doesn't come down, then certainly there could be some correction in our market. Finally, what we need is the fundamentals. Sentiments and flows can change very quickly, but it is the fundamentals which drive the market. What we have to look at, will India's growth continue as expected? Monsoon is a cause of concern. Energy prices is also a cause of concern. But I think over a period of time, we should be able to mount all of these worries and convince investors that these are the factors which will support overall growth in India. Our call remains marginally overweight large cap, marginally underweight small and mid cap, neutral weight to equity, and any correction in the market is an opportunity to increase allocation to equity. From an investment point of view, please remember, next slide please, that even God can underperform benchmark index for a long period of time. Over 10 years, Warren Buffett's Berkshire Hathaway has not provided any extra return over S&P 500. It has actually underperformed S&P 500. In a world where legend like Warren Buffett is not able to outperform benchmark index, Indian fund managers have done a great job. If I look at my team's performance over last 6 months, 1 year, 2 year, 3 year, 5 year, on a rolling return basis, not just one day's point-to-point return, but a rolling return, we have added value to our customers across most of the funds and across most of the time periods. That value addition is visible even in hybrid funds. That value addition is there across most of the funds on a point-to-point basis also. In hybrid fund also, that value addition is visible. And if we look at systematic investment plan across equity funds, by and large, we have been able to add value to our investors. Kotak Flexi Cap, one of our largest equity fund, in fact, industry's largest equity fund, despite size, has picked up performance as investment discipline has started coming into play. On that size of fund, we have to run Flexi Cap like a tanker. And you could see that that discipline, which we never forgot, has helped us, has kept us in good state. Yes, there were periods where we were not able to outperform benchmark indices. But if you remain invested, keeping faith on Kotak investment team, it has delivered outperformance over index. It has delivered extra return over index across many of the time periods. Multi-cap fund, which we had launched, which is a combination of large, mid, and small, has also generated alpha since inception of 3% and almost 8% alpha in last 1 year. it is one of the best performing multi-asset fund, multi-cap fund, thanks to the discipline which Devinder and the team is displaying. Except Kotak Global Innovation Fund, where the net asset value, despite launch 3 years back, remains below par. Across all the fund, we have been able to generate positive return for our customers. Some of the funds launched 3-4 years back, like Pioneer or Focused Fund, have delivered great return to investors. Even some of the funds launched in recent times have also delivered great performance. Coming to fixed income, as I mentioned earlier, inflation seems to be picking up across the world, including in India. The FOMC Fed future rate is indicating one rate hike and thereafter rate correction towards end of the year. India continues to maintain positive real interest rates, whereas US has negative real interest rates. And this has resulted into a situation where real interest rates are favoring India. Hopefully, that will keep our rupee supported. The RBI believes that the inflation this year will be somewhere around 5.2, well below RBI's tolerance, upper tolerance range of 6% on inflation. Inflation, while in few items like spices and cereals is on the higher side, most of the other items is very well concentrated within RBI's tolerance range. Inflation targeting framework announced by the Reserve Bank of India and Government of India seems to be working, and which is where we are seeing now our inflation level remaining below American inflation level for a sustainable period of time. On the fiscal deficit side, revenues have been fairly robust, and it looks like that the budgeted estimate for FY23 will be easy to achieve. The 10-year yield has declined in recent times from 7.5% to 7%. This is driven by expectations that globally interest rates will be cut over a period of time. We believe for next 3 to 4 months, maybe rates will consolidate at this level. And after there is a certainty on US Fed rate getting cut somewhere towards the end of the year, our journey may begin on the way down thereafter. So there is a 3 to 4 months of consolidation on interest rates in the near term. Liquidity has come down from a very high level, but it is still comfortable at roughly around 1,80,000 crore. We continue to believe, as there is a consolidation phase in interest rates right now, the best area to invest, best maturity to invest is somewhere towards middle of the curve between 3 years to 7 years. Similar to tug of war in equity, the 10-year yield, if it has to come down, that will be driven by when does RBI start cutting rates. RBI's rate cut will begin after Fed has started cutting rates. And there is also a mystery buyer which had invested 1,60,000 crore in Indian government securities last year. We believe this entity, this set of buyers might be linked to India's purchase of Russian oil. Now, if they continue to buy, rates have more room to come down. In case they decide to sell, then rates have more room to go up. On the other hand, if rates have to move little bit on the higher side, well, if there is a hawkish commentary by Fed, then rates could move up a little bit. If fiscal slippage happens ahead of election budget or election vote on account, then rates could go up. And most important thing is the monsoon and its impact on inflation. We believe rates will remain around the current level of 7% for some time to come. And thereafter, they may start moving down depending upon the Fed and RBI pivot. On the debt side, while debt taxation benefits have gone away, the benefit of anytime liquidity, professional management, getting a diversified portfolio with as little investment as 500 rupee, and deferring the tax, as on mutual fund you pay tax when you redeem, still continue to provide great advantages to the customers. Dynamic bond fund is something which is fill it, shut it, forget it kind of fixed income fund. It has delivered a reasonably good performance over its benchmark, even though debt indices are difficult to replicate. It has a reasonably long track record of performance. And if you take a 3-year, 5-year plus view, then on a rolling basis, it has delivered high single-digit return. We have continued to promote our tortoise and hare family of funds, funds which are hybrid in nature, and where equity allocation sometimes are dynamic, sometimes are static, but both creating higher upside participation and lower downside participation. If you look at balance advantage fund, the average equity allocation over last more than 3 years is about 42%. But with that, the upside participation is 56%, and the downside participation is about 34%. Currently, in balance advantage fund, the equity allocation is about 50%, little higher than our historical average. But these are the funds which continue to provide higher upside participation and lower downside participation. In equity saving schemes, over the last almost decade, average equity allocation is 29%, but upside it gives 40% participation, and downside it cuts by more than half at 14%. The upside downside ratio is more than 3 times in Kotak Equity Savings Fund. At this point of time, our equity allocation is about 32%, little above our long-term average. All these funds are appropriate for investors who want slightly better return than fixed income and is willing to bear some amount of volatility. I want to bring your attention to Kotak Equity Savings Fund. Here, the fund gets equity taxation thanks to its position between overall equity and arbitrage position. The net cash equity, as you have seen, is on a historical basis 29%. It moves in the range of 10% to 50%, and balance we achieve by way of equity arbitrage. The fixed income investment in this portfolio is ranging somewhere around 35%. Put together, this has delivered fantastic return with little extra volatility over fixed income fund, but much higher return than fixed income fund. On a taxation basis, this fund continues to provide equity fund taxation, 15% short-term capital gain, 10% long-term capital gain. This is great product to offer to investors who want to move from debt to slightly higher level of return at slightly higher level of risk. Kotak Debt Hybrid Scheme also is one fund which has done very well over the decades. The fixed income portfolio remains somewhere around 75% and equity somewhere around 25%. And through this combination of 25-75, it has been generating low double-digit return over the years. And more importantly, it is adding alpha to the investors through its disciplined investment. Gold, for some time we have been bullish gold and saying that this can outperform fixed income. our confidence is coming because central banks around the world are buying gold. If we see gold bought in last 22 years, Russia, China have been the large buyers. We believe even other nations will start following Russia and China footsteps and build sufficient gold reserves. The other reason why gold will get supported is potential correction, potential drop in US Fed rate. Whenever US Fed rates have come down, it has resulted into gold prices moving up. In every cycle when Fed rate has come down, gold has started moving up. The only factor which you have to consider in mind while investing in gold, that on gold right now there is 15% import duty. The day import duty comes down, rupee gold prices to extent will come down. Subject to this factor, we remain bullish on gold from an investment point of view.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.